Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Thursday, May 20th at 1 p.m. in London. Morgan Stanley's global economists and strategists have spent the last several weeks debating and forecasting what the next 12 months will hold. The conclusion? We think growth will be good, but those strong economic winds are becoming more complicated for markets. Over the next 12 months, we see a strong global economy supported by the largest fiscal stimulus, the largest monetary easing, and the highest consumer savings rates in history. Low investment over the last decade has set the stage for a significant rebound in capital spending. Increasing rates of vaccination support a faster normalization relative to prior recessions. All of this differs from the last 11 years, which was frequently defined by fiscal austerity, a lack of investment, and a weak consumer scarred by the global financial crisis. This break from the prior regime is a central part of our story. As is often the case after recessions, what follows is different from what came before. Instead, investors face a different dilemma, a hotter, perhaps shorter cycle. Hotter because the global economy enjoys these significant tailwinds. Shorter because these tailwinds could bring unusually fast normalization. A shorter cycle is not necessarily bad. The US economy saw a number of them in the roaring 1920s and 1950s. But it would be different, and we argue for a more mid-cycle market despite being only a year removed from the lows of activity. But strong economic winds also bring complications. Will a stronger economy mean a larger rise in inflation? Could that mean that central banks tighten policy more quickly? Would hotter conditions bring more margin pressure or higher corporate taxes, themes that my colleague Mike Wilson is very focused on? Is a better economy already reflected in investor optimism and high valuations, especially if interest rates rise? These problems are not insurmountable. A better economy leading to higher prices, tighter policy, and higher interest rates is a completely normal pattern of events. Yet the backdrop is unquestionably complicated. Just 14 months from the lows, investors face early cycle timing, increasingly mid-cycle conditions, and late cycle valuations. Given that backdrop, our key advice to investors is as follows. First, strong economic winds create both risks and opportunities. We are reducing exposure, primarily by reducing in corporate credit. The asset class has had an outstanding run, but it is expensive and disadvantaged in a hotter economic cycle. Second, these risks favor stocks outside the US. We maintain a small overweight in global equities overall, which still enjoys more elevated risk premiums, better mid-cycle performance, and higher 12-month return forecasts relative to other assets. Our top region is Europe, followed by Japan, where both regions have less inflationary pressure, less risk of changing tax or central bank policy, and less expensive valuations. We lower US equities to neutral, given higher risks for all those factors. Third, we expect a modest rise in interest rates, with the US 10-year Treasury yield rising to 2% in 12 months' time and the 10-year German Bund yield rising to 0%. That rise in yields might seem at odds with our expectations of better global growth, but Morgan Stanley's interest rate strategists believe that quite a bit is already in bond market prices. In currencies, we see the US dollar modestly stronger, the New Zealand dollar strengthening even more, and weakness in the Japanese yen. Markets will no doubt see many twists and turns over the next year. This is how we see that story for the moment. We'll let you know when the views change. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.